360. This is the wrap of the top funds and investment insights in South Africa and beyond. Joining this evening, not only Lindsay Williams in our Cape Town studio, but also Warren Dick from Investors Monthly, who's sitting right here in Johannesburg with me. And tonight on the show, we look at a conscious capitalism and how to invest in art. If you have any questions, you can call us on 011-384-0598. And remember to follow us on Twitter, hashtag investment360, of course, at CNBC Africa. Before we go any further, let's take a look at the local news today with Tamishu.
Thank you, Bronwyn. While Capitec's net loan impairment expense rose by 92% to just under 2 billion rand, the bank also reported a 26% fall in the value of new loans advanced, which now sits at 9.5 billion rand. Now, these figures display a worrying deterioration in the bank's client base, as well as concerns about the economy. An Anglo-American announced that it has settled 23 standalone SILICOSIS claims instituted against it between 2004 and 2009. Anglo-American South Africa is just one of many companies facing class action litigation in the High Court involving some thousands of former mine workers. This settlement does not affect its High Court case. And Taste expects its first half headline earnings per share to be 20 to 30% higher. Taste invests in a range of franchise restaurants such as Maxi's. And consumer confidence slumped to a decade low in the third quarter as strikes hit the manufacturing and mining industries and fuel costs soared to a record. All this according to the F&B RMB index. And Altron forecasts a 0 to 5% jump in its interim headline earnings per share. And finally, President Jacob Zuma has just signed the e-tolls legislation into law. Now, those are your news headlines. It's back to you, Warren.
Thanks very much to me. We just wanted to intro our first guest tonight, which is James Howard. He's the portfolio manager at the Development Equity Fund at Future Growth. James, thanks very much for joining us tonight. We obviously wanted to get a little bit more understanding about what's been going on around this socially responsible investing. And we've had many guests on the show that we've been chatting to. It seems like it's become a bit of a buzzword, James. So we just wanted to ask you, what exactly is your understanding of social responsibility investing? And is it becoming a bit of a trend, a bit of a fashion topic to be investing in at this point?
Yeah, it's basically been around from Future Growth's side for a long time. We started socially responsible investing funds about 15 years ago. The Development Equity Fund that I'm responsible for was started 7 years ago. And yes, over that period, we've seen a lot of education, a lot of understanding. We've developed a lot in terms of how we engage with it. The result has been over the last 18 months to 2 years, where our clients, mainly the bigger pension funds in South Africa, have engaged a lot more, and there's a lot of interest, and there's a lot of buzz, as you put it, around it.
James, what criteria does a company have to achieve in order to be seen as socially responsible and fall into your portfolio?
There's a lot of latitude around the actual definition of socially responsible, but the fund as such, it focuses a lot on high impact, real on the ground sort of facilitation of tangible sort of change for areas of the economy and sectors. For instance, education, healthcare, affordable housing and stuff like that, where we can make investments, and notably these investments need to have really good returns in terms of what we go out and our funds basically invest on behalf of the pension fund community in South Africa. So it's got to have real good returns, but at the same time achieve this high impact, socially responsible effect into the economy.
It seems it's evolved quite a lot, James, because reading back on the history of this Development Equity Fund, you used to invest in, I guess, BEE schemes back in the late 90s. So it's obviously evolved more into this infrastructure, a big connotation, but very much in a private equity format. So just take us through how the fund actually operates.
Okay, you're quite correct. This all started off many years ago when there was RDP and those buzzwords around. And we initially provided money, and it was under the mandates from the pension funds, to put it into BEE and getting that sector sort of, and the newly returned from exiled managers into the economy and sort of getting the BEE going. It was a very necessary step, but from an investment point of view and a model, it didn't really achieve sustainable long-term returns. So what happened is we pursued that, and as I said, a lot of lessons were learned. That we now apply in the new fund, which is far more sustainable over the long term. I suppose really the best way to explain it is to say that we look for partnerships with very strong management, great companies with a good track record, and we go in, and the nature of that is normally private equity. We go in and we're fortunate in being able not to have to offer a private equity model. We use Old Mutual's balance sheet, and we offer a pooled, open-ended investment. So we can look at the longer term in terms of a relationship with the companies. And that helps a lot because it's normally a company with, as I've given the credentials, but the growth aspects and the possibilities of going forward with the management team, whether it be developing and increasing market share and their effect that they have in South Africa, and then looking and supporting them as they cross borders and move into neighboring countries and into Africa. And that has given us a massive ability to give the returns that we're looking for.